Welcome friends. Our today's module we will discuss about financial statement analysis. Now why do we do financial statement analysis? Financial statement basically comprises of profit and loss account or income statement and balance sheet and cash flow statement. Profit and loss account or income statement gives us the series of activities in a particular time frame, most probably or most preferably a financial year, and their operating result. In other words, in a particular period of time frame, all the commercial activities are resulting into some net result which we know as profit or loss. And balance sheet, as on a specific date, it shows what is the true and fair value of the company in terms of assets it owns and in terms of liability it holds. Now, why do we do financial statement analysis? Financial statement analysis is important from 3 points of view. One from the investor point of view, one from the lender point of view, and one from the company management point of view. Why from the investor point of view? Investor point of view, it is necessary because when investors are putting money in one particular business or organization, they would like to know what is the performance of the company in a particular year. They would also like to know what is the performance of the company as compared to its peer group or the industry standards. This will give them a solace that their investment is in good hands and giving proper returns and giving proper operating results. From the lender's point of view, when a company or a business entity is going to raise new loans, the bankers or the financial institutions, they would like to understand what is the financial performance of the company. They would like to compare this financial performance of the company with various industry standards and their benchmarks and see whether this particular entity is eligible for new loan or not. And from the company management point of view, this will enhance the financial efficiency of the company, how the company is performing. So basically, financial statement analysis is a tool and techniques to assist proper decision making. Ratio analysis is one of the major tools of financial statement analysis. So financial ratio analysis is the use of relationship among financial statement accounts to gauge the financial condition and performance of the company. Various important items are included in the financial statement analysis, and as a result, they are understood how the company is performing. We are classifying the ratios in the type of information the ratio provides. First, the activity ratios. The activity ratios basically judge the effectiveness is putting its assets investment to use. The liquidity ratios, their ability to term short-term immediate obligations. Solvency ratios, ability to satisfy debt obligations, and profitability ratios, ability to manage expenses to produce profits from sales. Let us discuss this in a little bit detail. What is activity ratio? The various assets are used to earn revenues. These activity ratios give us a benchmark or help us to gauge how efficiently the various assets are used to generate revenue. For example, when we talk about inventory activity ratios, inventory turnover ratios is nothing but how fast class of inventory or a group of inventory is generating revenue. When you are talking about receivable turnover ratio, here it is seen how fast the receivables or the credit sales are turning into cash generation of the company. Liquidity ratios basically helps us to gauge the short-term solvency of a company. How fast the short-term assets can fund the short-term liabilities. For examples, when we talk about short-term assets, we have stock, we have receivables, we have cash, and we have some short-term investment. And the short-term liabilities are creditors and short-term loans. So liquidity ratios give us an indication whether our current assets are enough to fund our current liabilities. How, to what extent our current assets are higher than the current liabilities to enhance or the short-term liquidity of a company. Solvency ratios basically gauge the long-term solvency or the long-term liquidity of a company. This is more gauged how our revenue or our net revenue is effective in servicing the various debt obligations. Profitability ratios are basically used to gauge to what extent the company is having operating profitability, net profitability, also what return the company is given to various class of stakeholders like investors or the total debt obligation and investors. So result, profitability ratios give us whether this investment is a reasonable profitable venture or not from the investor's point of view and the total assets utilization point of view.